Hello and welcome to this month's monthly market update. My name is Steve Latham and I am the Chief Investment Officer for Bernanke Wealth Management. And for the March monthly update, we are going to be discussing yields and Fed expectations and where we think the Federal Reserve is going to proceed with monetary policy over the course of the next 6 to 9 months. So let's start with where yields have moved since the beginning of the year. What you want to look at for the Treasury market's yield curve, as displayed in front of you, is the shifts in yields based off of the different maturities. And so what this chart is showing here on the left-hand side is the overall yield level for each varying maturity. So we have 3.8% up to 5.6% for this chart. And then the overall maturities that are issued by the United States Treasury. So starting at the overnight rate, going all the way to the 30-year Treasury bond. And what we can see is the red line is the yield curve as of the end of 2023, and the blue line is the yield curve as of the beginning of March. And really on the front end of the yield curve, or the left side, we haven't seen a lot of movement, and that represents the expectations for the Federal Reserve near term haven't changed all that much. But what we have seen is a pretty significant shift here in the 3-year, the 5-year, 7-year, and 10-year, and so forth, for where yields will be longer term. And basically what this is telling us is the market has expected that the yields for Treasury bonds or government bonds will likely stay higher for longer than what we expected just a few short months ago. And now, the other way that we can look at that, or the interpretation of why yields have increased, is really specific, at least in this day and age, to where inflation is expected to go. And so just taking a look back of where inflation has come from and where we're at today, well, this top chart here shows 3 different measures of inflation. The orange line is the Consumer Price Index, or the CPI, and that's largely followed by the media and most other retail outlets as a generic measure of inflation. And so we peaked in 2022 at 9.06% for CPI. We've since come down in the most recent reading all the way to 3.15%. So we've made measured progress on the fight against inflation. However, the Federal Reserve likes to look at a more nuanced measure of inflation called the Personal Consumption Expenditures Index, or PCE. And now that is measured by the purple line. And that peaked at 7.12% around the same time that the CPI peaked. And that's actually come all the way down to 2.4%, which is pretty close to what the Federal Reserve's target rate is, which is at 2%. Now, making it a little bit more nuanced even further, they like to look at the core PCE, which excludes more volatile measures like energy, gasoline, or food like groceries. And so that peaked at 5.57%, not as high as every other measure of inflation, but that's only come down to 2.85%. So it's not as much progress as the Federal Reserve would like to see in order to start cutting interest rates immediately, but it's progress nonetheless. And what Jerome Powell has said in recent meetings is they don't need to see inflation continuing to drop further. They just need to see it staying around the same trend that it has been moving in the last 3, 6, 9 months. And just as a note, whenever we're looking at what the Federal Reserve is targeting for their overnight rate or their interest rate that they charge for overnight lending, that's this chart here on the bottom. So currently it's at 5.5%. Really it's 5.25 to 5.5%. And you can see how quickly they moved that up just over the last 18 months and then have been holding it steady for about the last 6 months. Now, that begs the question, where do we think the Federal Reserve is going to move next? Well, the next chart is going to show us what the market's expectations are for the Federal Reserve's next move. Now, they have a meeting coming up here on March 20th, where it's widely expected that they're going to not reduce the interest rates. They will keep it at that 5.25 to 5.5%. But you can see in this chart, and forgive me, it's relatively busy, that the expectations for a rate cut have actually significantly been pulled back. So to explain this real quick, we have a variety of different lines up here at the top, and each one of these colors represents a rate range that is the range the Federal Reserve would be expected to keep the interest rate range in at their next meeting. This would happen to be the March 20th meeting, and so that means the current range is this 525 to 550 basis points, or 5.25 to 5.5%. Now that orange line represented here is, at least as far as when the market was looking at this in January, expected that the rates weren't going to be anywhere near that. In fact, there was a wide expectation that it was going to be cut. But since then, that expectation for a cut has significantly decreased, in the sense of the 5.25 to 5.5% range is going to be maintained, because that would suggest that there's 100% chance that the Federal Reserve is going to maintain that rate range for the March 20th meeting. Now that chance is only slightly reduced for their next meeting at the beginning of May, and right now the market expects the first cut to be happening in their June meeting. So as far as Fed expectations are concerned, we started the beginning of the year with 7 to 8 rate cuts on the table. Now we're at 3 to 4 rate cuts. Part of that is because inflation has been a little more sticky here for that last mile of getting towards that 2% rate target that the Federal Reserve is looking for. But we also believe the market may have gotten a little over its skis as far as what they were expecting for rate cuts at the beginning of the year. So currently we're not expecting a cut for the March 20th meeting, and we're not expecting a cut for the May 1st meeting. We do believe the first cut is likely to come at the next meeting after the May one, which would be June. And if that's the case, we would have expected to see inflation continuing to trend lower, albeit perhaps at a slower pace, and the consumer staying relatively resilient on the back of a resilient economy. I know we went over a lot today, so if there's any questions as far as fixed income is concerned, the Federal Reserve, or where inflation's going, please don't hesitate to reach out. We'd always be happy to answer your questions. Thank you.